Imagine holding a match to a stick of dynamite, knowing exactly when to blow it out before it shreds your hand. Now imagine doing that with $1 billion. That is the world of George Soros. We aren't talking about generic buy low, sell high advice today. We are decoding the playbook of a man who treated global economies like his personal laboratory. A financial alchemist who realized that markets don't just reflect reality, they distort it, bend it, and sometimes break it entirely. If you feel like you're constantly reacting to the market instead of dictating it, listen up. By the end of this episode, you are going to walk away with 10 explosive, counterintuitive strategies derived directly from Soros' legendary career. These are the tools to spot bubbles before they burst, exploit regulatory chaos, and turn false narratives into cold, hard cash. We are going to show you how ignoring these principles didn't just cost companies millions. It wiped entire industries off the map. Get ready to rewrite your playbook and let's dive in. So strategy number 1, the Midas mirror. Most people think a company's stock price is just a scorecard. Soros realized it's actually a printing press. This is the concept of reflexivity in its purest form. So in the 1970s, Soros watched the REIT, retail real estate investment trust boom. Those companies didn't just sit on high stock prices. They weaponized them. They issued new shares at a premium, used that cheap cash to increase their book value, which then convinced the market to drive the stock even higher. It was a self-reinforcing loop of creating value out of thin air. But here's the danger zone. When the narrative cracked, the math worked in reverse. Soros shorted the sector and made over 100% profit. Mathematically impossible in a standard short sale because as the companies collapse, he kept selling more. The lesson, if your business model relies solely on cheap capital or hype cycle, you are building a skyscraper on quicksand. When the mirror cracks, you just don't fall, you vanish. And now here is strategy number 2. It's called the paper tiger acquisition. This is about aggressive, relentless growing using funny money, quote unquote. Soros dissected the conglomerate boom of the 1960s. Think companies like LTV. These giants used their high PE stock to buy boring companies with low PE ratios. Instantly, their earnings per share jumped. Not because they sold more widgets, but because of simple arithmetic. The market applauded this growth with an even higher stock price. But this is a Ponzi-esque game. LTV eventually collapsed into bankruptcy because they stopped buying real businesses and started buying earnings statements. The takeaway for you, if you're growing through acquisition, you must pivot to operational consolidation before the market realizes your growth is an illusion. Otherwise, you're just a paper tiger waiting for a match. And now strategy number 3. It's called the biological ticker tape. This is wild. Soros didn't just use charts. He used his lumbar region. Soros famously admitted that he utilized acute physical distress, specifically backaches, as a signal that there was a flaw in his portfolio that his conscious mind hadn't spotted yet. In the lead up to the 1987 crash, he ignored the white noise of conflicting data, but he couldn't ignore his back. When he failed to listen to his somatic marker in 1986, holding onto Japanese positions too long, his fund's value dropped roughly 26% in a short window. The lesson? Your subconscious processes data faster than your logic. In high stakes leadership, if the data looks good, but you feel physically ill, stop. Deleverage first, rationalize later. And now we're going to the fourth one, which is called the rational heretic. Conventional wisdom says be a contrarian. Soros says only if the trend is exhausted. So from 1982 to 1985, the US dollar was soaring despite a massive trade deficit. Classical economics said it had to fall. Soros fought the trend early on and got crushed, losing money for 4 years. He realized that in a reflexive market, the false trend, like a soaring dollar, can validate itself by attracting speculative capital. He switched gears, rode the irrational wave, and made a fortune. The critical business lesson: don't stand in front of the freight train just because it's on the wrong track. Ride the trend until the fundamentals literally cannot support the narrative anymore. Being right too early is the same as being wrong. Now, the next lesson is called the fortress consolidation. When the economic tide goes out, you don't build new ships, you scrap the old ones. Soros identified the oligopolarization of America during the strong dollar period. US manufacturing was getting decimated. The smart players didn't try to grow. They stripped assets, fired overhead, and consolidated into oligopolies to regain pricing power. The companies that tried to expand production during this deflationary cycle, like those in the oil and farming sectors, were annihilated, leading to the Continental Illinois Bank bailout. And what is the takeaway for you? In a high rate, deflationary environment, growth is cancer. Efficiency and cash flow are your only oxygen. Now, strategy number 6 is called the zombie shield. This is dark, but hear me out, it's brilliant. When you owe the bank $100, that's your problem. When you owe the bank $100 million, that's the bank's problem. During the 1982 international debt crisis, major banks didn't foreclose on a bankrupt nations like Mexico. They formed a cartel of lenders and loaned more money just so those nations could pay interest on the old money. It was a charade to keep loans at a face value on the books. Eventually, the illusion broke, and the bank shares traded at a massive discount. But the strategy bought them time. The lesson for modern finance: if you are facing a systematic failure with partners or creditors, don't cut ties. Bind them closer. Make your survival essential to their survival. Strategy number 7 is called the anti-delusion diary. The human brain loves to rewrite history to make us look smart. Soros hacked this bug. So here's a case study. The entire third section of the Alchemy of Finance is the real-time trading diary. Soros forced himself to write down his thesis, his prediction, and his bet before the event happened. In phase 2 of his experiment, this diary saved him. He saw his thesis on the imperial circle was flawed, admitted the error, and cut his losses. Without that diary, he likely would have held on, rationalizing the market moves, and turned 2% loss into a catastrophic wipeout. Stop lying to yourself. Document your decisions. It's the only way to separate luck from skill. Now, strategy number 8, the fertile fallacy. Marketing genius often lies in promoting a concept that is technically false, but powerful enough to make itself true. Soros looked at Reaganomics, deficits plus a strong dollar. He called it a fertile fallacy. It was economically flawed, but it was fertile because it attracted foreign capital that temporarily validated the booming economy. Compare this to the 1980s oil boom. Investors believed that the fallacy that oil would rise forever. When that fertile idea turned sterile, oil collapsed from $30 to a single digits, bankrupting lenders like Penn Square. The lesson? You can profit massively from a bubble, but you must know it's a bubble. Ride the wave, but keep your life jacket on. Now, we move on to strategy number 9, which is called the broken syllogism. This is for the operators. Find the moment a regulation changes, but the market's perception hasn't caught up. Soros analyzed the savings and loan crisis. The government deregulated what S&L could invest in, but still guaranteed their deposits. It broke the syllogism that banking is safe and boring. Entrepreneurs like Charles Knapp exploited this gap to grow Financial Corp of America from $4 billion to $20 billion in 2 years by taking massive risk with the government-backed money. The loss? The S&L bailout cost taxpayers over $100 billion. The strategy: when regulations shift, move with lightning speed into the new opening before the market adjusts, but get out before the inevitable regulatory crackdown. And now, strategy number 10. It is called the river over rain. This is the ultimate macro strategy. Money flows matter more than the goods. Let me say that again. Money flows matter more than the goods. So in 1980s, Japan had a massive trade surplus. Classic economics said that the yen should rise. It didn't. It fell. Why? Because Soros watched the capital account, not the trade account. Japanese investors were flooding money into the US treasuries, propping up the dollar. Investors who look at the real economy, trade, got crushed. Soros looked at the financial economy, capital flow, and understood the game. The lesson? In a global economy, follow the money, not the merchandise. The flow of investment capital drowns out everything else. Soros didn't become a legend following the rules. He became a legend by understanding that the rules are often illusions, waiting to be exploited by someone bold enough to see the cracks in the facade. Whether you are scaling a startup, managing a portfolio, or leading a corporate takeover, remember, reality is reflexive. Your perception changes the market, and the market changes you. Now, if you want to armor plate your mind against the chaos of modern business, hit that subscribe button right now. Do not wait. Next week, we are deconstructing a strategy so controversial, it was banned in countries. You don't want to miss it. And I'll see you. Make sure you hit the bell, subscribe, comment, share. I'll see you in the next episode. Peace.